Hey everyone, welcome to another episode of AdMail. This is Adam Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everyone, and welcome to another episode of AdMail. I'm Adam Bergman, tax attorney and founder of IRA Financial. And on today's AdMail, three superb questions. One, dealing with Roth contributions to a solo 401k as an employer profit sharing. Are they tax deductible? We'll see in a second. Second is, if you unfortunately have an IRA investment in a company that went bankrupt, how do you value that investment? And then the third and final question is involving making IRA contributions and using an inherited IRA to actually fund that contribution. So pretty cool question. So without further ado, let's get started. First question from YouTube. And the question is, if I elect to do Roth employer profit sharing contributions for my solo 401k, will they be tax deductible? So we know that right now, employer profit sharing contributions can be in pre-tax or Roth. Okay, so obviously if you do a pre-tax contribution to the employer contribution, which is 20% of your net Schedule C or single member LLC income, or 25% of your W-2, up to a maximum of 66K or 73.5 when you include the employee deferral amount of 22.5 or 30. Okay, generally most people do it in pre-tax, but you are now able to do it in Roth. So the question is, are those Roth contributions tax deductible like a pre-tax? Unfortunately, the answer is no. Why? Because you get double benefit. You get a tax deduction, and then you'd be able to pull that money out tax-free once you reach the age of 59 and a half, and the Roth has been open 5 years. So the way it works is, if you do Roth after tax employer contributions, you got to pay tax on the money you put in, and then they're in Roth, just like a Roth IRA or Roth 401k, deferral employee. And then once you're 59 and a half, the Roth's been open 5 years, pulled out tax-free, but you don't get a tax deduction for the Roth employer contribution. The business does, but you individually don't for making it. Since it's a business deduction, the business will give you the money, you pay tax on it, business gets the deduction, you don't personally, and you just then recontribute it after tax like a Roth 401k, employee deferral. So thank you for that question. Second question is from Harold T. of Houston, Texas. Harold wants to know, how do I value my IRA if I lost my investment because the company I invested in went bankrupt? Well, sorry about that, Harold. Yeah, things do happen, unfortunately. The way you would value it, you essentially value it at zero. I mean, when it comes to a self-directed IRA, it's up to you to provide a fair market value of the investment. You would provide that to us so we can file a 5498. Generally, in situations where there's like Ponzi schemes or losses, clients won't go to the zero valuation until they have essentially guarantee that the money is not coming back. Now, let's say the money does come back. That's okay, because you'll just increase the value in the future. So let's say you invested 100K in company XYZ, it's in bankruptcy, so now you value the interest at zero. But let's say there's a bankruptcy exit plan next year and someone pays 30 cents on the dollar, so now your 100 grand is worth 30K. The next year on your 5498, you'd have 30K as the value. So just because you have a zero doesn't mean that it's zero forever. It could always be increased or decreased accordingly based off the value at the time, 12/31 of the year in question. So you want to be as accurate as possible. And just because you put a zero valuation doesn't mean it has to stay at zero. Now, a lot of people, what they do in these cases is they'll do a Roth conversion at zero, assuming they believe that the company will come out of bankruptcy or the investment will have some later return. That's obviously risky to some degree. There's no tax due, but is it worth the process of just doing a conversion, having a new Roth account, paying the fee if the value will be zero in the future? So it's not a tax risk, it's more just an administrative cost risk. And some people don't care. It's cheap to have an IRA. They'll say, I'll keep it in Roth for a few years. If anything pops, great. If there's an exit plan or some type of workout plan, great. Or someone buys the company out of bankruptcy, who knows? If not, I'll close the Roth in a couple of years. But either way, the Roth conversion at zero value, has some tax planning opportunity. So thanks for the question, Harold. Third and final question of today's podcast from Ben S. of Cambridge, Massachusetts. Ben wants to know, I want to make a contribution to my IRA this year. If I have an inherited IRA, can I use the inherited IRA distribution to make a contribution to the IRA? The answer is yeah. The only thing to consider, Ben, is you need to have income. So as long as you have some income during the year, let's say you made 50K and you don't really have a lot of spare cash because, hey, it's expensive to live, inflation, you got credit card bills, rent, all that great stuff we all deal with. And you have an inherited IRA where you got 20K, let's say, from your mom or dad or someone else. So it's non-spousal. And you have that 20K, you pay tax on it. But you're like, hey, I don't really need to use all that. Instead of saving it personally, why don't I just dump 65 or 7,500 into an IRA or Roth and let it ride and let it save tax-free? Can I do it? The answer is yeah. So long as you have income, Ben, you can do an IRA, whether it's pre-tax or Roth. That may depend on certain factors, but you will be able to make an IRA contribution. So yes, assuming you don't need to use all the inherited IRA distribution to live and you have some extra cash, it totally makes sense to save in an IRA versus a personal account because you can take advantage of the power of deferral, compounding returns, which you cannot if you save using a personal account non-tax exempt. So great question. I may have spoken to you about this. It's a really good idea. I actually never really thought about it. But in your case, you didn't need the money or you were going to use some of it, but not all of it. And you're like, hey, can I just dump some into an IRA? And the answer is yes. So long as you have income, you can take any sources of cash and put that money in the IRA, so long as you have sufficient income to cover the 65 or 7,500, depending on your age, for 2023. So thank you, Ben, Harold, and the individual from YouTube. Really appreciate the questions. Really good questions. And whoever is listening or watching, if you have questions, don't worry, send them in. I promise I will do my best to keep everything as confidential as possible. So don't be shy, don't be concerned. No one's going to know who you are. If you have a great question, there's probably 100 people behind you that also have that same question and would really benefit from you sending it in. So you can email it in to info@IRA Financial. You can chat us. You can hit us up on YouTube, Instagram, Twitter, Facebook, whatever. We'd love to hear from you. And the beauty is, hey, the information gets shared and we all can benefit from. I learn from it, and hopefully lots of people that are listening and watching will also learn from it. So thanks again for hanging out with me. Hope you enjoyed the podcast. If you're watching on YouTube, thank you. Definitely want to subscribe to our amazing channel. Try to keep the podcast, as quick as short as possible. Just know you're busy. I just want to give you that answer with a little bit of fluff, just to give you some clarity, some color, but not too much. So you can move on to your day, get the info you need, and be a better self-directed investor. So thanks. Have an amazing rest of your day, and see you again next week. Ciao.